Please welcome our next session, the 2026 Economic and Multifamily Forecast.
My name is Peter Stanley. I'm the National Director of Multifamily for Marcus & Millichap and oversee our investment sales platform for multifamily across the entire country. So, this morning I'm excited and I want to welcome Marcus & Millichap's own John Chang, who's our Chief Intelligence and Analytics Officer, and also in layman's terms, runs our investment research platform. So, with that, excited to introduce John Chang to the stage.
Thank you, Peter. Looks like we're just starting to pull some people in. A little bit of an intimate audience today, so hopefully they'll find this engaging and interesting. We've had a couple of years of challenges. The last couple of years have been a little more difficult. Ever since they started raising the interest rates, it really put the kibosh on a lot of the investment opportunity and a lot of activity. We've seen some slowdowns. We've seen a lot of development. So it's really a dynamic market right now. And I called this, the headwinds to horizons outlook, because we've had so many challenges over the last couple of years as an industry. Just looking at what it costs to deploy capital, how many people got out over their skis, how the development has really reshaped the market. So I'm going to talk a little bit about that and also talk about the opportunity that I see and where I see this going as we move forward. So there's always something, right? It doesn't matter what year it is or when I stand up here. We just had that government shutdown. We have AI is a big topic. We just had a panel talking about how to leverage that. We have what's happening with the Federal Reserve. We have the elections in New York, and we have the tariff policy as well as immigration changes that are really reshaping the dynamics of the marketplace. When you look at the uncertainty level across the country, it's shot up to its highest level on record, far past what we saw during the pandemic, to a record high in April when the tariffs were announced. And it's settled down quite a bit since then, but it's still really elevated compared to what it traditionally would look like. And that uncertainty is stalling decision-making and making it more challenging to make decisions, regardless of whether you're talking about investment or you're talking about just running a business. When you look at what's happening with job creation, both the terminations and layoffs, as well as people resigning their position and looking for a new job, as well as the hiring, has come down to a very low level over the last 6 to 9 months. It's tumbled and it's come down pretty dramatically since April. And that's basically reflecting the uncertainty. The employment market, the companies are stepping back and saying, let's wait and see what happens. And so that really just tends to slow down the entire perspective on the economy. And so it makes it very, very difficult to understand what's coming around the next corner. Now, earlier this year, up through July, I was looking at the employment numbers and everything was looking pretty good. We were still creating jobs. This is a trailing 3-month average up on the screen. And we were creating jobs up until August 1st, when they went back and made a major revision. And it turned it around from a modestly rising trajectory into a falling one. Now, we haven't had any new job numbers since August. Because of the government shutdown, they didn't get any release out for September. The September jobs numbers are going to come out this Thursday, so we'll see what those look like. They may not even have the October job numbers because the government was shut down for the entire month and that collection didn't take place for all that data. So we're going to have choppy data, and it makes it, again, much more difficult to make decisions. We don't know what the future holds for the employment market. So this is creating a lot of challenges for multifamily and other investment classes. When you look at the forecast for job creation, Through August, we had added about 600,000 jobs. We're still forecasting that we'll be somewhere around 900 for the year nationally. The unemployment rate is right around 4.2, 4.3 right now, and we anticipate that in 2026 that the unemployment rate will rise up to about 4.5 to maybe 4.8%. That is kind of a consensus estimate. So we expect the unemployment rate to rise, the job creation to slow down. We're predicting only about 300,000 jobs for 2026. So we're still projecting a slowdown in job creation. And the big question is, it's teetering very close to the edge on whether or not we go into a recession or not. And when you look at the leading economists out there, they're all saying pretty much the same thing, which is recession is unlikely. It's possible, maybe 35, 45% probability, but it's unlikely. When you look at all their forecasts, they're still positive for economic growth, but it's very thin. And then when you look at the question of whether we hit inflation, there's an open debate on that as well. So it runs all the way from a stagflation scenario all the way up to slow growth outlook for 2026. And where we land on that spectrum is going to have a lot of impact on the multifamily market and other types of commercial real estate. When you look across the country at the jobs over the course of the last year, this is year-over-year change through August, because that's, again, our most current data, you can see it's very spotty. Some of these are red, some of them are green. And so you have different markets that are performing in very different ways. You have some that are still holding strong and rising. You still have some that are facing headwinds. And so unlike perhaps a normal year, when we talked last year, we still had positive momentum pretty much across most markets. And at this point, it's choppy. There's different metros facing different headwinds, while some are still moving forward. We're still creating jobs in New York and Phoenix and a few other metros. And on net, we're still positive, but the momentum is slackening. And a lot of this is tied to what's happening with tariffs. Right, so we had those tariffs that were lifted up on the beginning of April, Liberation Day, and that just created a whole new dimension for our economy. We haven't had these in 90 years, and never in the modern economy. So this creates a lot of uncertainty, a lot of headwinds, and not only that, it's that they keep moving. If in April the president said, well, we're going to put 10% tariffs or 15% tariffs. In fact, the number really doesn't matter. But if they put a flat number out there and just said, okay, we're done, one and done, then there would have been, the market would have adapted. But when it gets rejiggered and it's different over here and different over there and you're moving it around frequently, people don't know what to expect. So in our industry, you look at the development cycle, for example. You look at the cost to build or renovate an apartment building. They're putting in a 50% tariffs on kitchen cabinetry, right? So anybody doing a remodel is looking at this and going, well, how's that going to work? All the kitchen cabinetry is going to go up in price. Bathroom vanities, right? Lumber from Canada, which is about 25% of the lumber we use, that's getting a tariff of 35%. And so, but it keeps moving. It was 15% 2 months ago, now it's 35%, who knows what it'll be in a few months. And again, that's what makes it challenging. People hold back and they go, well, I might wait. I'll wait and see if it goes down. And when people wait to see if things go down, that's when they get, it slows down the entire economy and the whole market as a whole. Now, the tariffs have yet to really play through into the inflation numbers. When you look at inflation, is still about 3%, and so it has not risen as many economists believed it would. Many were forecasting 4.5% by this time, and it really hasn't come through. And there are two main reasons for that. First of all, everybody stockpiled inventory as the tariffs were coming on. So they were stockpiling all the consumer goods and everything else. They got on a boat, they got it in before the tariffs hit. And we're still burning through some of that inventory. The second reason is that a lot of the businesses, a lot of the companies haven't passed those cost increases through to consumers yet. So according to Goldman Sachs, about 65% of those tariff expenses have been absorbed by the companies, and they will ultimately be passed through to the consumers. They believe that over the next several months, we're going to see that trickle through. A lot of companies are waiting until after the holidays. A lot of the auto companies were waiting until their 2026 vintage cars were coming out, and they're stacking them in there and kind of hiding them. But they're still going to be coming out. And so the belief is that we could see inflation start to rise over the course of the next year. And so as a result, the Federal Reserve is taking a look at this, and they're saying, well, we have two jobs. One, maximize employment, and the other is to control inflation. And right now, these are at odds, right? So the employment numbers have been getting weaker and weaker and weaker, which means the Fed should cut rates. But they fear that inflation is going to start to surge in 2026. So they're afraid that if they lower rates, it's just going to exacerbate the inflation and start to take off again, and we don't want to see that happen. So it's always a really challenging decision to make. You know, the Fed has such a tough job, and you know, if you think about it, who here would like to be the next chairman of the Federal Reserve? Anyone? I know I don't want that. Oh, there's one. Just start cutting rates. It'll be great. Well, here's the toll it takes. You look back at when Chairman Powell took over as the head of the Federal Reserve, and here's what he looked like in his most recent press conference. So you may want that job, but trust me, there's a lot of pressure and there's a lot of challenges. Yeah, you don't have to worry about your hair. That won't be it. You won't have anything left. It'll look all gray. Anyway, the point is, this is really hard. They're trying to balance two things that are going in opposite directions. When you look at the interest rates, they've dropped rates twice this year, down 50 basis points, once in September, once in October. The question is, will they cut rates again in December? Now, up until October 29th at the last Fed meeting, the probability, according to Wall Street, of a rate cut in December was about 92 or 93%. I just checked today, it's down to about 45, 46%. So that probability of a rate cut in December is coming down pretty aggressively because there's concerns about the employment market and the economy and inflation risk going forward. However, if you look forward farther, if you look forward into late 2026, maybe mid-year or late 2026, the forecast is that they will still continue to cut rates. So we still see that downward pressure on rates over the course of 2026. It's just not going to manifest as quickly, and there's a lot more questions involved. And quite frankly, the outlook on rates is really very, very difficult to decide right now because at the end of January, there's going to be an event where the Supreme Court effectively decides what's going to happen with the Federal Reserve. And this slide has a lot of information, a lot of pictures here. But essentially, there's a board of governors, that's Chairman Powell and 6 other members of the Federal Reserve Board. At this point, 3 of them were appointed by Joe Biden, 3 of them were appointed by President Trump. And there is a challenge. President Trump tried to fire Lisa Cook and terminate her. That is going to the Supreme Court. They will decide that or they will have a Supreme Court hearing on January 31st. And the reason that is important is because the other members, there are 12 Federal Reserve Bank presidents, 5 of them get to vote on rates in 2026. I think that's New York, Philadelphia, Dallas, Cleveland, and one other, I can't remember which one it is. Anyway, it's listed up there on the screen. So you have those 5 voting members. But all 12 of those Federal Reserve Bank presidents are up for renewal at the end of February. And in order to be renewed, they are nominated by their local Federal Reserve Bank boards, but they all have to be approved by the Board of Governors. And depending on how the voting is being handled at the Board of Governors, you could see a lot of these presidents be changed out. And specifically, those 5 who are going to be voting in 2026 are going to be the ones that are going to be at the highest risk of not retaining their position. And so as a result, the voting membership of the Federal Reserve Board could change dramatically over the next few months. If it goes one way, we could see rates start to come down pretty aggressively. If it goes the other way, we could see it slow down quite a bit. So it's really hard to predict right now. It's in the hands of the Supreme Court. What they decide on January 31st will have a tremendous impact on the rate policy of the United States. So that's going to be a big trigger point for us to watch. So, stepping beyond that, the rates, on the lending rates, have been actually coming down quite a bit. When you look at the loan officers that were tightening, we went through a tightening cycle, it stabilized, and those rates have started to come down. When you look at what's happening with the loan to values, we've seen them rising. Basically, the financial institutions' confidence in the commercial real estate market as a whole is improving, and their confidence in the financial markets themselves is improving. So they've tightened up their lender spreads, and we're starting to see those rates come down despite what's happening with the long-term rates, the 10-year Treasury and some of the others. When you look at the lenders that are active, we can see a huge section there, right up at the top right corner there, which is labeled as private lenders. Those are debt funds. Debt funds have come into the market pretty heavy. They are putting a lot of capital out. They're offering bridge financing and other options for investors to help them get through some challenges. But they've added a lot of liquidity to the market. At the same time, the banks had been pulling out of the investment market. They've been pulling out of the lending market over the last couple of years because their balance sheets were getting a little wonky. There were some banks that closed and so on. So they stepped back for a little bit, and we're starting to see them come back into the market at this point. And so the liquidity in the marketplace is continuing to improve, and the lending is becoming more accessible. When you look at the Mortgage Bankers Association forecast for the coming year, they're predicting about a 25% increase in lending, which is also up dramatically from last year and the year before. So we're seeing more momentum on the lending front, which is creating more liquidity for the marketplace to help the transactions happen. Now, I went back and looked at some of the rates. Remember last year when the Fed was cutting rates, they cut them 100 basis points, and there was a lot of transaction activity spurred by that. We saw a big shot in the arm in the deal flow. And if you look back and compare the rates today to where they were last year at this time, they're down 50 to 80 basis points. So even though the 10-year Treasury is actually higher, it's 30, 40 basis points higher than it was a year ago, the lending rates are actually down by 50 to 80 basis points, depending on the asset quality, the borrower, location, which property type it is, and so on. So there's, of course, a lot of variables in there, but the rates themselves have trended lower over the course of the last year as we've seen that stability enter the marketplace. And again, that is a unique opportunity because when you look forward at the rates, we don't know which way they're going to go, and there's a lot of challenges out there. It could be more volatile. And so right now you're kind of in a unique window where rates have stabilized at a lower level than what we've seen for much of the last 2-3 years. So now I'm going to shift gears. I'm going to talk a little bit about what's going on with the housing market and housing demand. Right? So the key ingredient here is demographics and the target rental age, and I've highlighted in orange the millennial generation. That's the key renter profile, and they're right in that kind of that sweet spot for renting. They're mid-30s, and they've been putting off home ownership. So if you look at the median age of the first-time home buyer today, it's now 40 years old. Last year it was 38. A few years ago it was 36. 20 years ago it was people in their late 20s were buying their houses. That was the median age. Today it's 40, and it's getting pushed back every year. So that's creating some unique challenges. To help alleviate this, they're talking about adding a 50-year mortgage, right? And saying, well, this will help affordability. But if you assume that if you're lending money for 50 years, instead of 30 years, there's a little bit of a premium on the rate. So I went and looked around, and the consensus is about a 50 basis point increase. So if you're looking at 6.3% on a 30-year mortgage, you're looking at a 6.8% on a 50-year mortgage. By the time everything's said and done, you're talking about a $60 difference in your monthly payment. So it really doesn't make a lot of sense for most people. They may qualify for a little bit higher loan, but the impact on their monthly payments is nominal. And not only that, people buying their first home, they're like 40 years old. By the time they get done with a 50-year mortgage, they may be, pretty much done. So there's a long journey in that. Most people don't hold it for 50 years, I know. They sell after 7 or 10 or 11 years. But still, nonetheless, there's not a lot of benefit to doing a 50-year mortgage, so I don't think it's going to impact the market, even if it does go through. And basically, the momentum is people are waiting till they're older to buy that first house. And the median home prices have risen. They're very sensitive to interest rates. Transaction activity has fallen. When you look at the spread between the average rent relative to the payment on a median priced home. This is not a mansion. This is, 1,700 square foot, 3-bedroom, 2-bathroom house. This is a spread of about $1,200 in the monthly rent versus the home payment that they would be making. So it's not very affordable. And not only that, if you look at the Freddie Mac qualifying criteria, only 28% of households will qualify for a Freddie Mac loan. And most of the people who qualify already have a home. So home buying is still way down, and it's going to be slow, and we're going to lose far less households out of rental housing into home ownership over the course of the next few years, even if we have a 50-year loan. When you look at across the country, different metros, those spreads range, of course, almost $10,000 in the Bay Area. And some of the more affordable markets, the spread is about $1,000 in the upper Midwest. If you get out into tertiary markets, it may be even lower. But nonetheless, there is a huge gap in the monthly expense of homeownership. And traditionally, as an industry, you would, especially in the Class A sector, you would have tenants, they'd come in, they'd rent for a year, 2 years, 3 years, whatever it is, and then eventually they would go out, they'd buy a house and move out. And there's a barrier to slow that down. That means you're going to retain more of your renters over a longer cycle. And as a result, the renewal rates in multifamily have pushed up over the last year into the mid-50, 55% range. And those renewal leases are generating positive rent growth. So there are a lot of concessions out there, especially across the Sun Belt, that's slowing things down. A lot of those new leases are coming in with negative rent growth in that first year. You're seeing 2 to 3 months of concessions in some markets. But on renewal, that's where they're making it up, and they're making some headway on the renewal lease rates. So looking forward, we've had some real challenges, as I mentioned earlier, with development, especially in the Sun Belt markets. The number of completions have been at a record level. In 2024, we shot through the roof. 2025, it came down quite a bit. It dropped, like 170,000 units less being completed in 2025 compared to 2024. So that's good, except for it's still a lot. And we're expecting it to drop another 110,000 or 140,000 over the next year. And so the new unit headwinds, that new supply risk, is beginning to come down. And absorption over the last couple of years has outpaced expectations. You can see it in the orange bars there. That's a trailing 12-month absorption compared to the completions on a quarterly basis. And so the absorption was outpacing this record wave of development. So household formation was good. There was a lot of demand for housing. And as a result, on net, vacancy rates came down over the course of the last couple of years, despite all of this new construction. But we are seeing the pace of absorption beginning to taper. We're starting to see it come down, and I'll explain that in a moment. But at the same time, as absorption is slowing down, we see construction slowing down pretty dramatically. If you look at the number of starts, it's down about 75%. You look at the units under construction, they're down 50%. So we see the outlook on new supply coming down pretty significantly over the next few years. And so the new supply challenges are going to abate. And then the market will start to catch up, and the momentum will shift from being in an oversupply, will burn off the overhang, and then we start to move back into an undersupply market. And once they slow down the construction pipeline, it will be very difficult and very challenging to get it up and going again for 3 reasons. First of all, when you look at the lending climate, the lending challenges on new construction have been very elevated. The rates were high. They started pushing up. That originally slowed down the pace of construction. When you stack on the impact of tariffs, that continues to drive up the construction costs for materials. Like I mentioned, kitchen cabinetry, bathroom vanities, wood, lumber, 35% tariff on Canadian lumber, 50% tariff on steel, 50% tariff on aluminum, 50% tariff on copper. All of these things that are used in construction are going to be more expensive. And so that's going to drive up your construction costs and continue to restrain development. And then the third dimension is labor force. With our new immigration laws and the more strict enforcement of immigration laws, the labor force for construction labor is being impacted. Now, officially, about 35% of the construction labor used today is non-native born. They're people who immigrated to the United States and they work in construction. I've seen unofficial numbers pushing up into the 50 to 60%, which is counting people who are not here legally. So your cost of construction labor is going to be driven up over the next few years as well because of our immigration policies. So combined, this is going to shrink the new supply risk and reduce that headwind, and ultimately, when you look out over 3 to 5 years, the new supply challenges go away. When you look at how many units were completed over the last 5 years, you see big numbers. 15, 20,000 a year for the last 5 years, even more than that in Dallas, where it was closer to 30,000 a year. And so there have been a lot of new units all across the Sun Belt that have impacted those markets. And as we look forward into 2026, you see the momentum starting to shift and slow down. Still got a lot of units coming online in Dallas and Austin and some of the other Texas markets, as well as, say, in Nashville or Charlotte. But it's tapering. It's starting to ease. And once you get over this hurdle in 2026, the pipeline beyond that is very thin, and it won't start up again because of all of those headwinds I mentioned. So then when you start to do your forecasting, you start looking forward beyond 2026, and you look at the supply-demand metrics, they become more and more favorable as you go forward. And the longer you look, when you start to look out over the horizon into 3 years and 5 years, the momentum shifts and the dynamics become quite strong. You look at vacancy by class, they're all kind of coming down. But when I break out the Sunbelt markets relative to the non-Sunbelt markets, you see a pretty dramatic difference in terms of vacancy, with vacancy rates in the Sunbelt pushing up close to 6%, the rest of the country somewhere in the 3s. And when you look at the metro forecasts across the country, again, the upper Midwest, see a lot of 3s up there. You look at the Sunbelt, you're looking at a lot of 6s in terms of vacancy rates. So you still see a lot of difference in terms of the performance. It's a really wonky market right now. I go to Chicago and everybody's cheering and they're seeing the best time ever. And I go to Dallas and everybody's saying, man, this negative rent growth's killing me. How long is this gonna last? So it's very different. It was actually just flipped from where it was just a few years ago as we navigate the supply headwinds and some of the other challenges. So those are our vacancy forecasts for 2026. They may be revised. There's still a lot of variables in play. When we release our investment forecast in January at the NMHC conference, we'll have these things dialed in and stabilized. When you look at rent growth, again, you look at by class, it's held up strong for the Class A, actually, relative to the other property types. And you look at the Sun Belt versus non-Sun Belt, the Sun Belt markets are negative, and they've been negative for the last year or so, whereas the non-Sun Belt markets have been performing better. But I was digging down into the Class C, right? Class C properties. And you see some very different dynamics. So if you're in Dallas or Texas or Florida where you have a lot of development and you had this oversupply, there's a lot of concessions. So your Class A is saying, hey, we have to compete, we have to fill up, we have to get stabilized, and we're going to offer up concessions. And they start discounting a month free, 2 months free, 3 months free. And then who moves in? Well, they pull somebody out of a Class B building. And then the owner of the Class B building says, man, I'm getting shafted here. I need to do something about it. So they start adding concessions and they start pulling in their Class C tenants up into the Class B buildings. And then your Class C properties face the biggest headwind of all, right? They're at the end of the stack. They don't have anybody else they can pull in that has credit, or they start running into tenant challenges. And so when you look at the different markets around the country, the Class C rent growth in markets where there's virtually no development or limited development, like at Chicago, you're seeing double-digit rent growth. And at the other end of the spectrum, when you have 10% or double-digit inventory growth, you're seeing really seriously negative rent growth in those markets. So the whole country, depending on the market you're operating in, you're experiencing an entirely different environment from an operating climate. And that's one of the challenges, that's one of the nuances and the opportunities that we see today. So when you look at the rent growth trends, it's all over the map. It's literally, it's scattered. You see different markets, you're seeing some positive numbers, see some negative numbers, there's some red up there, there's some green up there, and so you have this patchwork quilt of performance all around the country, and the opportunity is positioning your investment strategy, factoring in these challenges. And you have to think forward. What's the supply and demand metrics look like during my hold period? Does it get better? Does it get worse? Where are the opportunities? But this is the kind of market where those opportunities emerge. You know, when everything was going great guns in 21 and 22, more capital was coming into real estate than ever before. It was a knife fight to get a deal. You were challenging everybody to get a deal. And the cap rates fell, and everybody was just piling into the Sun Belt, and a lot of those investors got out over their skis, and now they're starting to have some headwinds and some challenges. Those deals are starting to turn and come back out into the market. Sometimes those investors and the syndicators are saying, look, I just got to get out. I don't even, I'm going to lose all my money. I get it. But I just want to get out so I don't have this cloud hanging over me going forward. So there are some of those deals out there. But these are the types of markets when there's churn, when there's different things happening all over the country, that you see the most opportunity. Now, I do have a headwind that I think could play a risk. When you look at consumer sentiment, especially among the lower incomes, the bottom 50%, the sentiment has fallen pretty dramatically. And historically, when you look at sentiment and relative to absorption, they tend to trend together. So when sentiment falls, absorption starts to get weaker. And when sentiment's high, you see more household formation, you see more demand for apartments. And so it's possible that we could see a slowdown in absorption. Third quarter was about 57,000 units nationally, down from over 200,000 the quarter before. So we're still positive, we're still getting demand, we still have positive momentum, but it's starting to slacken, and that ties back to that uncertainty I was talking about, that ties to the slowdown in job creation I was talking about, it ties into people deciding to double up because they're not sure what's around the next corner, they don't feel secure in their jobs, and so we will probably see that absorption pace come down a little bit more over the course of the next few quarters. Whether it turns negative or not will really depend on how the economy shapes going into 2026, and that's still a little bit of a wild card. Now, when we talk about sales trends, the momentum, again, I was talking about 21, 22, and how much activity there was then. Then it dropped off. The Fed started raising rates. The activity dropped like a rock. We hit bottom in 23, and it's been kind of climbing up ever since then, very slowly. Now, I think the momentum is shifting. I was just did a tour of clients up in New York, met with a lot of institutions. They have capital building up, and they need to get it placed. They are looking at multifamily as one of their targets. And so I do anticipate that the institutional capital will start coming back in 2026. We're seeing a little bit of it already. We're also seeing a lot more private investors get more active now because there's a little bit more clarity and a little bit more opportunity over the long haul that they're seeing. When you look at the investor activity, it's predominantly been private investor. We've seen that big pullback from the institutions over the last couple of years. So I anticipate we'll see a little bit more institutional capital starting to flow. And when you look at price and cap rate, the prices have stabilized, those cap rates have gone up. Now, when you look back farther, when you look back at average cap rates going back 35 years, there are only 4 times that cap rates have materially increased in the last 35 years. There was in the 1990s, they did it twice during the RTC times. Then there was the global financial crisis. Cap rates went up during that cycle, and you can see that up on the screen, or the edge of it, and then they started coming down, and then the current cycle. And when you reflect back, what happened after they went up? They started coming back down again, and that was when a lot of people made their money. And a lot of the opportunity that we see today in the challenges of the current marketplace, that is the point at which a lot of people are starting to shift gears. That's when other people, when so many investors are concerned, when they don't have clarity, that's when they pull back and they sit and wait. But those are also the best opportunities historically. When you look at the cap rates by market type, you're getting a little bit of a premium for your tertiary markets. Your secondary markets, you're starting to see those cap rates come down a little bit. The momentum is shifting. You look at it by class, and you can see that the Class A is starting to turn a little bit. When you look at the cap rate by metro all over the country, you can see those ranges there. And again, it's really dynamic. If you look at what's happening in New York right now, you're seeing some of the highest cap rates in New York that you've ever seen. Now, that comes with a lot of uncertainty, right? You have a political environment in New York that is different from what we've experienced in the past, and so there's a lot of uncertainty tied to that. But you can actually get into, in some areas, in some neighborhoods, you're looking up into the, 8 caps, and there's, when was the last time you saw that? So there are opportunities out there, but you have to be able to drill down and look at what's the outlook for this market. I was talking to an investor just last night, just bought a brand new building in Austin, got a great deal. There's been a capitulation in some of those properties that were recently developed because of the oversupply and the attrition they've seen on rents and the challenges getting to stabilization. So it's a very unique market right now. It's really challenging, but for investors who are really paying attention, the opportunities are some of the best that I've seen. You look at the spread between the cap rate and the treasury rate, it's widened out a little bit, but that's not always the best measure because again, the 10-year treasury today is about 40 basis points higher than it was in September of last year, but your Fannie Mae and Freddie Mac financing is 50 basis points lower than it was a year ago. So that's the opportunity out there. Just a few other things shaping the market as I wrap up. The tax policy has improved. 100% bonus depreciation on new acquisitions. That is creating some unique opportunity. Carried interest was not touched. That was actually on the list to be eliminated, and it was not. So that's a positive. 1031 exchanges are retained. Section 179, so if you're doing a value add deal, you can leverage that Section 179 bonus depreciation up to $2.5 million. And so there's a lot of little bits and pieces in there that are bolstering the outlook for commercial real estate investment that should start to entice more money to come into the market. And then as I wrap up, key things that are supporting multifamily investment. All right, even though we built a ton of apartment units over the last few years, we still have a structural housing shortage in the country. We're going through the process of absorbing a very rapid increase in inventory over a short period of time, but that will stabilize and we'll move on, but we still have a housing shortage and the cost of housing is still expensive, and that's a barrier into home ownership. The pace of construction is slowing, and I think it's falling and won't be getting back up anytime soon. The high cost of home ownership is that barrier. It's going to drive retention of renters. The pricing recalibrated, that is a rare event where the pricing recalibrates to the level that it has, and the cost of debt financing has come down pretty significantly over the course of the last year, and it's opened up that spread on positive leverage, not everywhere, but here and there on individual assets and individual markets. And that positive leverage is a key trigger that is going to bring more capital in the marketplace. And as we see more capital come in, that's going to drive those cap rate movements over time. So I'm going to wrap up. I got about a minute to answer his question.
I think a lot of developers are finding attracting GP capital, LP capital rather, to invest with them on new construction is very challenging. Are you seeing anything opening up there? And also pivoting, are people willing, are those folks willing to do more straight LP versus preferred equity? And then secondly, is that money going to buy secondaries, which you hear a lot about these days?
So you're right. A lot of the capital is not going into development. It's they see the development risk right now. So the developers are having a hard time raising capital. I was just up in Seattle a few weeks ago, and I was meeting with some developers there, and they were saying, "Hey, I have 2 deals that are shovel ready. I'm ready to go." And I said, "Okay, what's stopping you?" They said, "We don't have any money. Nobody's investing. We can't pull it together." So that is definitely going to be a challenge. I am hearing, however, that some of the construction costs are actually coming down for a short period of time because the development pipeline has thinned so quickly. I'm sorry, I didn't catch the other part of your question.
Pivoting from preferred equity to straight LP and also buying secondaries.
I can't give you a good answer on that. I'm not that in tune with the capital flows right now for that tier of capital, but I know a lot of people who will be in that Marcus & Millichap booth out there a little bit later, who might be able to provide some insights. Any other questions? All right, well, thank you very much. I appreciate your time.